Brad Williams, Frugal Finance. Understand the IPO lockup period and its impact. An initial public offering, an IPO lockup period, is a contractual agreement that prevents insiders such as company founders, employees, and early investors from selling their shares for a specified time after the company goes public. The typical lockup period lasts 180 days, though it can be longer for SPAC IPOs, sometimes stretching to a year. Key takeaway: the lockup period keeps insiders from selling shares immediately after an IPO to avoid flooding the market and depressing stock prices. A standard IPO lockup typically lasts 180 days, while SPAC IPOs may have lockups of 180 days to 1 year. Lockups are not required by regulators, but are implemented by the company or the investment bank managing the IPO. Investors may benefit by waiting for the lockup period to end, potentially acquiring shares at a lower price. Why lockup periods exist? The main reason for IPO lockups is to prevent insiders from overwhelming the market with shares, which could lead to a rapid drop in stock prices. Insiders typically hold a significant portion of a company's shares, and selling large amounts could signal a lack of confidence in the company's future. Furthermore, the lockup period helps avoid the impression that insiders are eager to cash out their investments, which could negatively affect the company's reputation. Additionally, even after the lockup period, insiders may be prohibited from selling if they have access to non-public material information, which would be considered inside trading. Legal context of IPO lockups: while the lockup period is a common practice, it is not mandated by regulatory bodies like the Securities Exchange Commission. Instead, the company or its underwriters impose the lockups to stabilize the stock post-IPO. The duration and terms of the lockup period are disclosed in the company's S-1 filing with the SEC, and any changes are announced through subsequent filings. Implications for investors: some investment professionals recommend waiting for the lockup period to expire before purchasing shares of a newly public company. This is because after the lockup ends, insiders may sell their shares, potentially driving down the stock price, especially in less favorable market conditions. Waiting allows investors to assess the stock's performance and avoid buying at inflated prices during the initial rush. For those concerned about potential stock price decline post-lockup, options like protective puts may provide a way to hedge. Speculators might also use calls or puts depending on their expectation for the stock's future movement. Case study: Facebook's lockup period. One of the most notable lockup periods occurred with Facebook after its May 2012 IPO. The initial lockup prevented the sale of 268 million shares, and when it expired, Facebook's stock price dropped significantly by nearly 50%. Facebook imposed additional restrictions on the sale of 1.66 billion shares over the next year, which added to the market's volatility. Can the lockup period be altered? In some cases, the lockup period may be shortened or waived altogether, usually if the company and its underwriters agree to make changes due to market conditions or other factors. These adjustments are designed to manage stock price volatility and ensure a smooth market transition. Can a company skip the lockup period? Well, most companies impose a lockup period. Some may choose to forego it, particularly in strong market conditions. Skipping the lockup period may signal confidence in the company's prospects, but it can also increase price volatility, as early investors may choose to sell immediately. Effects of the expiration: when the lockup period ends, a significant number of shares become available for sale, which can lead to volatility in the stock price. If insiders choose to sell their shares, it could flood the market, often resulting in a temporary decrease in stock price. However, the increased share availability might also attract new investors, potentially boosting the stock value in the long run. Conclusion: an IPO lockup period is designed to stabilize stock prices after a company goes public by limiting the number of shares insiders can sell. While not legally required, it helps maintain confidence in the company's stock and avoids market disruptions. Investors may find opportunities to buy shares at a lower price once the lockup expires, but should carefully consider the market conditions and the company's performance before making a decision. If you have any questions or concerns about IPOs or IPO lockup periods, comment. Brad Williams, Frugal Finance. Thanks for watching. Hope that helps. See you soon.